Sharp rebound in D Street with Nifty reclaiming the 23,600 mark. Deeper cuts seen in small caps while most sectors traded in the red. Auto, consumer durables, PSU banks led the declines with IT emerging as the lone bright spot. Tata Steel slips despite a sharp jump in Q4 profit with analysts split on the outlook. While JP Morgan has downgraded the stock to neutral, Morgan Stanley continues to back it with an overweight rating. Meanwhile, Power Grid also lags after reporting a weak set of earnings. Gland Pharma jumps after a strong Q4 and with record quarterly revenue. The management sees CDMO emerging as the core growth engine with revenue addition of $40 to $50 million in FY27. Amba Enterprises remains under pressure despite a steady Q4 performance. Management flags 50 to 100 bips margin pressure at the consolidated level, citing high commodity costs, rupee depreciation weighing on margins. Tata Small Finance Bank's board has approved a fundraise with TVS Venu Group among key investors. The group will acquire around 9.9% stake for nearly 400 crore, and that's an ET Now exclusive. ICICI Prudential Life hits 52-week low on Bharti deal. Prudential Life is set to acquire 75% stake in Bharti Life for 3,500 crore and will reduce its stake in ICICI Prudential Life and ICICI Prudential AMC. Hi there, good afternoon. You're watching Closing Trades on ET Now. I am Snehi Shah, and just take a look at the recovery that we've seen from the day's low on the market. It raised most of those gains or most of the losses, that we had seen since the get-go today, and absolutely flat now for the Nifty 50. At one point, we were lower by more than 1%. So it's a very good recovery coming in. 23,634 is where we are at right now. 23,657 was the day's high. So we're about 25 points lower from the day's highest point, but looking good in terms of the recovery that we've seen. Taking a look at what the sectoral move is, and IT still continues to be the only sector in the positive with a gain of more than 2%, and it's pharma that has joined this basket now, about 0.5% higher. Nifty Bank is absolutely on the flat line, but you have some cuts on Nifty FMCG, metal, oil and gas and realty, with auto, defense and energy being your top losers. It's Nifty Auto that's lower by about 1.7% right now, led lower by TVS Motors, Uno Minda, Hero MotoCorp and Bajaj Auto. This is what's happening on the sectoral front, but if I take a look at what's happening in the broader end of the market, the Nifty 500 still continues to be in the favor of the declines. It's about 390 stocks that are in the red right now, with 110 stocks in the green. So that's the kind of tilt that we're seeing in the Nifty 500 group of stocks. It's Amba Enterprises, KC International, both on the back of weaker than expected earnings, seeing cuts between 10 and 15% each. Gallant Ispat continues to sink. You have CE Infosystems that's also lower by 7%. Afcons Infra on the back of that 4,500 crore order cancellation coming in is lower by about 6.6%. HFCL, Himadri, SJV and Cochin Shipyard are all seeing cuts of 5% or above. On the flip side, it's Gland Pharma on the back of very good set of numbers, 14.25% higher. GE Shipping, Shipping Corporation, both the shipping names are doing really well in trade, followed by the mid-cap IT basket, Coforge, Tech Mahindra, Persistent, OFSS, all of them are doing well, along with the solar industries. That's up about 4%. So that's the kind of roundup that we're seeing in the market right now. From the Nifty 50 that has now tilted towards the green, you still have 20 stocks in the green but 30 in the red. But we've seen some recovery on names like Tech Mahindra up by 4%. Bharti Airtel is now higher by about 2%. Infosys, JSW Steel, Kotak Mahindra Bank, Bajaj Finserv are your top Nifty 50 gainers. And on the flip side, you do have something like a Power Grid that's lower by about 4%. Tata Steel, despite inline set of numbers, is lower by 3%. SBI, Trent, Bajaj Auto, Maruti, these are some of the Nifty 50 losers. So that's the kind of tilt that we're seeing in the market right now. Yes, we've seen a recovery, but the favor still continues to be towards the decline. So we'll take a look at what the last hour and a half of the trading session holds for us. But meanwhile, let's take it across to my colleague Avi, who's joined us on the show with a list of all the stocks that are buzzing either on the back of earnings reactions, news and updates or brokerage reactions. Avi, over to you.
Let's discuss the stocks that are trending in news today, starting with TVS Motors. TVS Motors is set to acquire 4.9% stake in Jana Small Finance Bank from Jana Holdings for a deal size worth 190 crores. This acquisition is expected to complete within the next 3 months. Talking about marine electricals, it has won an order worth 209 crores from Adani Infra and Udupi Cochin Shipyard. Talking about Amazon India, has committed that they will deploy 1,000 Aisha Motor electric trucks by 2028 for the Amazon Now segment. Talking about Bondada Engineering, has won multiple orders amounting to 460 crores from Adani Green Energy. This order book is for the supply of goods and services for the balance of package system for a 250 megawatt solar power project. The execution timeline for this order is 8 months. Talking about Symphony, is down almost 9 to 10%. This is because their revenue and EBITDA is down 30 to 50% respectively. They've taken a 259 crore impairment for their Australian business. Management says that they won't invest any further money in their Australian business, and Symphony is going to acquire the US business from their Australian subsidiary for 30 crores. Talking about KEC International, the numbers with respect to revenue and EBITDA are down 7 and 17%. This is because of labor shortage, fuel constraints like the LPG shortage and the elections. Management guides that this drag could be seen for the next 2 quarters as well.
Okay, so that's a list of all the stocks that are in focus right now. We also have Kunal Botra who's joined us in the studio. Kunal, good afternoon. Your reading on the kind of recovery that we've seen in the market from the day's lowest point.
Spectacular recovery, staying because something which was unanticipated, but something which I think was built up right throughout the trading session today. So there's something which is very strange which happened in the morning today. When the Nifty was down 200, 300 odd points on the downside, the Bank Nifty I think at one point was down 850, 900 points. The put call ratio for the index jumped up, which is a very rare phenomena, very, very rare phenomena, that the put call ratio climbs above the 1 to 1.2 mark. That indicates that there was a huge amount of put writing which was going on for the Nifty since the last 2 sessions, and especially at those strikes sub the 23,600 mark, 700 mark. In fact, the cumulative at one point of time, the cumulative 5 best strikes just out of the money on the put side had a cumulative open interest of almost 5 times the cumulative open interest on the call side from the index perspective for the weekly expiry, which is tomorrow. So I think that's one of the major reasons why you saw the markets going into a bounce back mode and why the Nifty is defended, or at least trying to defend, this 23,600 to 700 range. So that I believe could be a major point of the reason for this bounce on the indices. But nevertheless, I think the market texture has been very good in terms of the sector approach. You've seen the Nifty IT index doing very well. The banking stocks, and it's very heartening to see the private sector banking names taking the lead in terms of a recovery as well as a potential breakout. So when you see such kind of signs as well as signals, it just indicates that maybe the markets are going back to a recovery phase. But this tomorrow's expiry is going to be very crucial, because if we hold on to that 23,700 mark, and if we don't succumb under selling pressure yet again, then there is a higher chance that the markets can come back into a recovery phase further.
Okay, and Kunal, let's say we are able to hold on to this 26,000 mark given by the time we close today. What happens tomorrow and what happens for the rest of the week? So what I'm trying to ask is, what is the next upside level that we should be watching out for?
So very strong probability first, saying that the markets would hold on to this 23,600 levels. What happens tomorrow possibly is that the markets would probably try and come back into a further recovery mode. My sense is that we should probably try and come back towards at least 23,700, 23,750 mark, if not more, for the Nifty in the next 1 or 2 days, and specifically for tomorrow, because it's the weekly expiry, and that's how the setup has been over the last 2-3 days, where there's been a huge amount of put writing for the current week. Going forward, however, I think if we manage to break past about 23,750 mark, it could be a lot of positive confirmation. Why? Because we are at an environment where the crude oil prices had spiked back again about $110, $111. The rupee is still depreciating at 96 odd mark. You've seen the dollar index at 99 plus levels. Now, in that kind of an environment, if we try and come back into a recovery phase across our markets, that's going to be a big positive for the index. The other very important part, which I think I discussed in the morning also, that there has been a global correction which is starting off for the emerging markets, and specifically for markets which have been outperforming. So, for example, KOSPI, Hang Seng, etc. They are the ones where the indicators are a tad bit overbought. So if the money flows out of those markets, possibly India could be beneficiary.
Okay. And Kunal, what about the broader end of the market? We've seen some elevated cuts coming in. Yes, recovery has also been seen to some extent on the Nifty mid-cap, but the small-cap index still continues to trade with cuts of 1.5%. What's the outlook on recovery here?
So this time around, it could be a little different, because earlier in many phases of the market recovery, we generally expect that the market breadth recovers first and then the large caps, come back into recovery phase. But this time around, it could be a little different. I would sense that, the mid caps and small caps would take some bit of more time, for themselves to recover, because if the money flows back into those large cap names, higher possibility that, the mid caps and small caps, they could either see maybe some round of profit booking or delayed buying. So I think in that sense, over the next few days, I would expect mid caps and small caps to underperform.
Okay, so that's on the underperformance of the mid-cap and the small caps, expected to continue for a few more days. That's the call coming in from Kunal. But let's dissect some of the names that are doing well, or in fact, they're under pressure on the back of earnings. Kunal, Amber Enterprises and KEC International, both of these stocks are immensely under pressure. KEC is down by 10%, Amber is down by 15%. Given the kind of move we've seen on these stocks, do they look good enough for a fresh entry?
Not really, not as of now, maybe not on the first day of the sell-off, because, even on daylight today, for example, where many stocks opened gap down and then traded on the negative side, there was a recovery for many of these names. Now, the ones which don't recover, even after a day like today, where you've seen the index recovering quite smartly from the intraday lows, that tells you that maybe the selling is not yet over for these stocks, and there could be more of a residual sell-off which could come into these names. So I would probably be a little bit on the sidelines into both these names, KEC as well as Amber. I sense that after this 10% plus kind of a sell-off into these names and the lack of recovery for these stocks, or a substantial recovery to put it simply for these names, there could be a possibility you might see these stocks drifting a little lower from the current level. So I think one should not hurry into buying this dip as of now.
Okay, and we'll get to Kunal's picks, but before that, let's talk about Jana Small Finance Bank. That stock is in focus today as the board has approved fundraising. Ankur is here to tell us more about that. Ankur.
Yes, as reported here on ET Now, Jana Small Finance Bank Board has approved fundraising to the tune of 729 crore. Now, in that, the important thing to note is that TVS's venue will acquire up to 9.9% stake in Jana Small Finance Bank. Now, this transaction to include both combination of primary issuance of warrants and the secondary stake sale purchase, and this is an expression of interest which has been given by the TVS Group, and TVS Motor Company will include 4.9% stake in Jana Small Finance Bank, and this is part of the transaction. Of course, the deal is subject to the regulatory approvals which are yet awaited, but for now what we know that the bank has approved raising up to 729 crore, and for that 1.56 crore warrants convertible into equity shares within 18 months will be issued by the bank. Now there are several investors, but more importantly the board has approved raising up to 500 crore via tier 2 bonds on a private placement basis too. But all in all, this TVS group entry into Jana Small Finance Bank is something to be noted, and now all will depend upon the regulatory approvals which comes in for deal. But for now the bank has been able to approve 729 crore fundraising.
Okay, Ankur, thanks so much for taking us through that. So that's an ET Now exclusive confirmed for Jana Small Finance Bank. But Kunal, before we talk about Jana on the charts, let's come back to your picks. Any stocks looking good this afternoon? Yeah,
I've taken one from the banking name, and I've gone with private sector banking name Kotak Bank. Very interesting chart, because the stock in the last 2 or 3 days slowly and steadily or gradually has started to show signs of strength, eking out a breakout for itself about the 385, 390 plus mark where it's trading right now. So would look at a near-term target of 410 for Kotak Bank. Stop loss could be kept at 380. The second is about Vishal Mega Mart. Now, a very interesting chart on the intraday basis, on the hourly charts that is. The stock is forming an inverted head and shoulder pattern. The breakout point is about the 120 mark where the stock is trading right now. So would look at 128 as a target. Stop loss at 118.
Okay, Vishal Megamart and Kotak looking good to Kunal on the charts. Kunal, while you're talking about Vishal Megamart, how are the other two names in value retail, V2 and V-Mart? How are they shaping up on the charts?
I think V2 is a more interesting one because even after this last 3 days of price correction for V2 retail, the stock corrected from 240 levels to 216, 17 where it's trading right now. The trend setup is very much positive. So, by that I mean that the last 2 weeks, 3 weeks, when the prices were moving up higher for the stock, we actually saw the volumes to be one of the better volumes for V2 retail. In fact, it was at a point where the stock was almost at a 3-week to 4-week high in terms of the weekly volumes. So the setup in volumes indicates that there will be new influx of buyers into the stock, and that I believe could be positive for V2 retail, which means that this dip should be bought into. Quite similar is the case for V-Mart also, but apparently the volumes were started to look attractive for the stock at the end of March, start of April, when the stock was at 500, 525 mark, and from there it's gained almost 20% higher. I would sense that corrections into this sector specifically, or both these names along with Vishal Megamart, I think should be taken as a good buying opportunity.
Okay, so that's the take on some of the value retailers on the charts. But viewers, on that note, it's time to slip into a very short break. We're holding on to that 23,600 mark, and we have about an hour and a little bit more of trade to go. So let's see what happens. We'll be right back with more news, updates, and more discussions on the other side. So stay tuned.
Well, so far so good, and much like anticipated earlier today, the dip has clearly gotten bought into. Now, of course, it remains to be seen whether this uptick gets sold into in the last lap of today's trade. But right now, it seems like it'll manage to hold through around the 23,600 print is where we're currently at. Tata Steel, it's recovered about 2% from the session lows. SBI, though, is still weak. In fact, for SBI, unfortunately, it's been pretty much a one-way trajectory since its numbers failed to meet the street expectations, and that's really taken a drubbing for the rest of the PSB pack as well. There's Maruti, which is down today, Bajaj Auto, Trent, Tata Motors PV, after that big move on Friday post its numbers, it's down about almost 2%. M&M, ONGC, of course, is a big reversal from where it started off trade, where it was holding higher by about 0.6%, and the complete reverse picture right now. It's the currency trades which are really holding out well. So look at a TechM, look at a Wipro, Coforge, which has moved up about almost 5%. Persistent is higher by about 4%. Emphasis is higher, nearly 4%. So that part of the market is looking good. And then, of course, there are names like Bharti holding up a good 2% as we speak right now. There is an odd Kotak, Bajaj Finance as well, which is holding out well. And then, of course, Solar Industries, post its numbers, also continues to hold up over 4% as we speak right now. But Meryl is here to flag off some of the other newsmakers this afternoon.
Well, yes, here's a list of stocks that we've seen buzzing in today's trade. Starting first with SH Kelkar. The company's profitability is what is driving the stock movement, down 98% on a year-on-year basis, with the management flagging an operating environment that seems to remain dynamic even going forward. What with the increasing raw material pricing environment? Now, the company did also flag off that the current quarter did not see a meaningful impact from these cost pressures, and that an additional impact may be seen going forward. So a negative to a muted outlook for SH Kelkar in the coming financial year is what seems to be driving its prices downwards in today's trade. Moving on, PDS Limited as well is in focus. The company's seen a revenue somewhat flat, but the EBITDA over here is down 16%, and profit again for the company is down 9.6% on a year-on-year basis. However, the company's quarter-on-quarter growth is what seems to be driving its price move, with PAT almost up 95% on a quarterly basis. Moving on, NCC as well is in focus. The company's revenue is flat, EBITDA down 1%, and EBITDA margin over here on this counter has contracted down to 8.8 from its previous levels of 9.1%. The company also saw its profitability decrease almost 19%. This was on the back of cost of goods sold as well as subcontractor work bills, which increased around 13% on a year-on-year basis. Next up is Deepak Nitrite, with the company reporting a revenue uptick of 2.7% on a year-on-year basis. EBITDA also up 20%. EBITDA margins also seeing slight expansion, with the company's cost of goods sold to revenue as a percentage decreasing by over 400 basis points on a year-on-year basis. And the last name on our list today is Phenotex Chemicals, with the company recording a revenue of 314 crores versus 120 crores from the last year, and a profitability up more than 58% on a year-on-year basis. So yes, these were some stocks that we've seen buzzing on today's trade based on their fourth quarter results.
Okay, let's also welcome on board Deepak Shenoy and find out what he's recommending doing in this market. Deepak, hi, afternoon. An extremely choppy one last week, and then you've got Brent spiking all the way back to 110 plus levels. Inconclusive China meeting between Xi Jinping and Donald Trump as well, and then of course the currency weakness as a big overhang. What's the current strategy in this market? Hold on to some dry powder or go all in, as should have been the case from the March lows?
Thanks, Aisha. In fact, I don't know if I can be of any help here, because I think the all of the events that seem to be happening are way beyond my pay grade in terms of what happens at China or what happens at with the oil situation. But to a certain extent, if you look a little bit further on, there is perhaps some internationally, at least, there's some acceptance that, listen, we can't continue this stuff forever. Look at the bond yields abroad. Look at where the US has reached 5.15 on the 30-year, 4.6 on the 10-year. The Japanese 10-year and 30-year are spiking. We're looking at much higher than 5% even on Britain bond yields. So I think there's a cost to having this war continue, to keep supply pressures high. There will be potentially some rise in interest rates in the West, at least. Indian bond yields are also reacting kind of in anticipation, though our inflation numbers haven't yet shown any major uptick, but we will see something for sure later this year because of the relatively more tough El Nino that we're having this year, and then all the oil spike downstream impacts. However, I think that by the end of the year, we should see some kind of a resolution, because the markets are reacting this way. The international players will also kind of get tamed eventually by the markets. And then once there is some stability, oil supplies start to come back towards the later half of this year, things start to look better. I think more difficult questions about the economy will come in, but the international pressures will not be so much. I think this is a good thinking point for India at point of, how much more we need to really generate more of our domestic manufacturing, to not have to rely so much on imports that, the dollar increase or the exodus of dollars causes us so much more damage within. However, if you look at results in the March quarter are actually quite good, way better than I expected. Median earnings are upwards of 18-19% in the Nifty 500. In the small caps, they're in fact about 20%. I think mid caps are also doing quite well in terms of earnings. There's balance sheet resilience. There's the ability to take debt if they had to expand on capex. And if there is some kind of a policy push towards more capex, more than it already is, there is some, but maybe add some more, there will be some improvement in the 3 to 5 year time frame. So if you're looking at getting into the market, you should have those kind of timeframes in mind, not like next month or end of the year. I think that is where you should do. But in general, I would say disciplined investing for retail investors is always useful. Don't try to time it too much in and out. If you're a trader, then I think the price kind of gives you the indication. And to be honest, the price has given no indication so far, neither of a breakdown nor of a breakout. So it's a bit of a wait and watch time. Some dry powder does help for someone who's more tactical in their allocations. But I would say disciplined investing, getting into the market, thinking of a 5 year time frame, that's what we can advise. I'm sorry, this is very boring because, we're mutual fund people. So we tend to say keep your investing boring. But unfortunately, I feel this is actually better advice than trying to time it right now.
Investing is boring, isn't it? It's all about patience anyway. But in the very near term, though, Deepak, do you think that the market perhaps is not right now pricing in the macros?
There probably isn't enough pricing in both from the upside and the downside. I think there's a lot more that we can do in manufacturing, and we are doing. And you're seeing some of the companies in the industrial show fairly robust results. There isn't enough appreciation for perhaps how much more resilient some of our exporters will be with the dollar at this level. There, on the downside, of course, I don't think we currently have an idea of how, for perhaps the fertilizer thing will pan out if there is a supply shortage continuing into the monsoon, if there is an inflationary impact on food, fuel, transportation prices, and how it translates downwards into consumer price inflation and therefore interest rates. There's a dichotomy here. I think some companies are undervalued because their growth is not recognized enough, and a lot of companies are also overvalued because we assume that the commodity level of earnings will continue going forward. These are all cycles, and I think some of these cycles will see a turn, some for the upside and some for the downside. And in that context, I don't think the overall market is overvalued. That the pockets of overvaluation, pockets of undervaluation. You have to be careful on what you buy. Stock, or a sector-based view, and we like industrials. We've been and we've seen that in the prices as well. A lot of changes have happened in public sector banks that seem to have shown a positive, but even that cycle seems to have kind of ebbed a little bit now. So there is a change of cycle happening as we speak, and I think it's important to get allocations right if you're a stock allocator or if you're a sector level allocator to appropriately reassign. And this is not a sign of like either a bubble on the upside or that we are at the bottom of the market. I think the macro will play out over the next 6 months. There's nothing you can do to stop it because, like I said, it's between different countries and we don't even play a part or play a meaningful role. It is to also accept that we will take time to recover. So as long as we have time in our portfolios to have the patience to do it, that's fine. If we don't have the patience, fixed deposit or a liquid fund or something will probably be a better option. But this market requires patience. It requires us to deal with this kind of volatility.
Right, Deepak, hi, afternoon. Since you've spoken about bonds and you've spoken about the kind of dollars outflow that we've seen as a country recently, talk to us about your view on the news that we've heard last week that the government is mulling to reduce taxation on FIIs investing in Indian bonds. How effective do you think this is going to be if passed to bring back the FII money back into India?
So it won't result in anything immediate. In fact, because of so many policy changes in India, the fear at foreign investor level is, listen, if they're letting us get out without tax, we might as well get it out right now. Because we've had so many policy flip-flops and we don't keep the same policy. We've said no taxes. We kept that policy on for 10 years. And suddenly we said, oh, taxes on Mauritius will come. And then we'll do backdated taxes. And then we'll increase the amount of capital gains taxes. And then we'll add something else. So because of so many policy changes over a short period of time, foreign investors are genuinely concerned, of course, and I would be too if I were them. We don't know what will happen in the future. You might as well look at it right now. But if we had a 10-year trajectory and we talked about it, I know any government cannot guarantee 10 years, but you create the plan and keep it. Even if there's a subsequent change in government, nobody comes and kind of disrupts the whole bus by saying that we'll reverse everything that the past government has done. But to actually do this, the thought process that says 10 years, we're going to keep the taxation levels constant or change our policy appropriately to not introduce this in the future, that would help. This particular thing on bonds is a complex problem, which we are very different in the whole world for. We charge capital gains taxes on bond sales. So if even Indian bonds are in the index, if people sell them, they have to pay capital gains tax in India. Any other country, does not charge capital gains tax on bonds to a foreign resident, in the sense a person who's non-resident in their country. So India becomes the special exception. We charge foreign investors TDS at source. Of course, we tax them only 5% on interest, but the TDS at source, because of some other rules, tends to be as much as 20%. They'd have to pay them sometimes twice over if they buy a bond in the secondary market, which is unnecessary, and therefore they have to wait for 1 year to recover the tax from the income tax department. These are things that we should solve at a policy level and kind of make it an even playing field. But you're not going to see the results of it now. You're going to see the results of it 4 or 5 years down the line. But I think it is time for us to start thinking 4 or 5 years down the line. Whatever is happening now is not going to get reversed by something that we do on a temporary basis. Otherwise, these taxes will just get reintroduced 1 year down the line. If we have to think about this, it has to be long term.
Indeed. Good point there. Deepak, hold on to that thought. We're going to take a very quick break and come right back. Back to closing trades right here on 80. Now, the rebound, of course, in the market is holding through. But look at some of the spaces which are really getting hit hard. Look at the entire EMS stack right now. That, after its earnings, has really seen a fair amount of correction. And if you were to really take all parameters, look at the top line growth, for instance. For Dixon, it's been an inline set, only a 2% growth that they've seen. For Keynes, of course, it was a big miss, a 26% downtick in the revenues. And for Amber as well, while it's been in line, it has been a growth of about almost 10%. For Sirma, again, an inline set of growth, it's a 58% growth that they've seen on the top line basis. Just looking at what's happening at the margin level, because for Dixon, of course, the margins have been in line, but yet it's been a degrowth of about 40%. For Keynes, it's been a big miss, a 140 bips decline is what it's seen. For Amber, it's been a beat and a 70 bips addition to their margins. But look what's happening on the stock today. For Sirma SGS, of course, it's been a beat and it's been a 26% bips addition to the margins that they've seen. At an EBITDA level as well, talk about Amber, it's been an inline set, a 21% uptick is what it's seen. And for PAT for Amber, it's been a miss and it's been a 15% growth that it's seen, but that's fallen short of what the market was anticipating. Deepak, wanted to get your views in on this entire EMS play, because I guess the large concentration of positions in the entire EMS sector is what obviously gives more elbow room for disappointment, right? And I guess that's what's playing out on Amber today.
I think overall, Aisha, there is a disappointment in these earnings. But if you look at the commentary, a lot of their capex is going to give rise to revenues and recognizable revenues and profits in the later part of maybe this year and next year. So if you're in this for a short term, I don't think this is going to make sense. The PE levels are relatively high. There's going to be volatility in earnings, not just in prices. But at some level, some of these players are actually on the right track in terms of developing the tech. We have to remember that we are so backward in terms of some of these technologies that we are actually living out the 70s and 80s that happened in the US and perhaps Japan, where we're starting to get to some position in terms of building semiconductors ourselves. And I'm not talking about some of the players you talked about, not the others. But in general, we have to manufacture, a lot more things like AC compressors, which are not even high tech in that sense. These are stuff that we can manufacture, we don't. So to a lot of this, these players will need the supply chains to reform in India or to build themselves in India in order to be able to scale up towards, either end user products or actually more fully built technologies from their end. And given that it takes time, I think the idea should be that the profits will come in 4 or 5 years from now. So yes, the prices become more attractive now, but if you're thinking of only if you're thinking of 4 or 5 years down is when the results will come. We are very early. These are not players that are going to produce anything high tech meaningfully right now. We are going to be learning in the process. These companies are going to have to fail, recover, and fail in some parts of their projects, recover, learn from that, and grow from there. So to that extent, I think it is a question of how much faith do you have in the sector and in the management itself. I don't think these are the results that we should, pay meaningful interest to. If, of course, if there's something seriously wrong in their commentary, I would say that I don't find that anything meaningful wrong for the long term. In the short term, I think everything's under pressure because of the macro.
What's up with pharma though, Deepak? Would you be tempted to add positions, cashing in on the GLP-1 opportunity?
Oh yeah, I mean, I think GLP. I mean, I would want to be a user. I've been thinking of it myself, but more importantly, it's a huge. Now it's already reached a certain, I think, 40, 50 crores a month, and probably much more than that. If you look at the US, they're talking of nearly 12% of adult consumers either having consumed or being part of this whole ecosystem. To the extent that Lay's had to shut down a factory because of lack of demand. So I think it is a positive, and I hope it comes through. To reduce relatively high obesity in India, more because of food and lifestyle than because of other reasons. But I would say there are downstream effects. If you have a big GLP market in India, this is, I mean, it's going to be well fought. So the margins are not going to be magnificent. Eventually, margins are going to come down on all profiles of GLP, but it will result in downstream impacts of people not having enough or wanting enough sugar, food, and all of the other things that perhaps drive a lot of FMCG consumption. So I would be much happier if these pharma companies do well and FMCG companies do badly, because that means India is getting healthier. But there is a market impact of something like that as well. But I would say, yeah, in the short term, at least in now, there is a lot of interest in them. We're seeing, I mean, Bangalore at least, and I know Bombay as well, perhaps there's a lot more ability to both consume and prescribe these drugs, and they have a seriously positive impact on health. Long-term impact, I have no idea. I'm not a medical professional, but I feel that at least the doctors that know seem to be saying that this is possibly a better way to handle a situation which otherwise seems to be uncontrollable. So opportunity is there. Margin pressures will come maybe 1.5 years down the line. So you have to deal with the players in a context of potentially declining margins on this drug, but the drugs in this area becoming very successful.
Yeah, and that multiplier effect on so many other segments also. I mean, BPC, apparel, nutraceuticals, so much actually opens up because of this. But Deepak, great to have you on the show. Thanks as always for your time.
Thank you so much. Thank you.
Okay, let me also welcome on board Dhananjay Sinha then and find out what he's recommending doing in this market. Dhananjay, hi, afternoon. Just looking at the IT trade, does it seem really tactical in nature as of now?
So I think the market has actually been has seen the IT sector actually getting derated quite significantly. I think over the last 1.5 years, there's a considerable underperformance. I think there has been concerns with respect to US policies relating to outsourcing, etc., and other things. So I think, and also the results and the guidance from the management hasn't been that great. So I think that has been the past. I think what's happening right now is that the earlier trade was largely with market capitalization shifting more towards banks and all. If you look at especially since mid of last year, I think what is happening now is that the investors' conviction on the banking sector is actually waning, largely because there has been, if you look at this quarter results, there has been a moderation as far as the NIMs are concerned. So these are NIMs compression, largely also to do with the fact that the yields on advances actually being on the lower side. And people attribute that to lowering of the interest rate cycle that RBI had actually continued. So I think as a result of that, people might be now shifting back to IT to some extent. I think that will be more of a defensive strategy rather than anything fundamental moving in favor of the IT pack. So though IT stocks appear to be pretty cheap, I think there has been a considerable derating, as I said earlier. So I think that is the kind of switch that is happening.
Okay. Dhananjay, hi, good afternoon. Let's talk about the recent developments that we've seen on the macro front. First we've seen this 3 rupee hike in petrol and diesel prices, and then we've seen the impact play out on the WPI number as well. Talk to us about how you're seeing all of these developments play out, and according to this, where would your estimate be for the CPI in the near term?
So I think the last monetary policy, if you look at it, they had actually cited how the inflation would transmit from high crude prices. So at $100, we've seen that crude has actually been hovering around there, and currently it is even higher. So I think RBI had actually articulated various channels. I think six channels through which higher oil prices would impact domestic inflation, etc. But we have seen that RBI kept its inflation guidance unchanged for this year at an average of year-end at 4.6%, whereas they were fairly sanguine about growth as well. So they were penciling about 6.9% growth in real GDP. I think as things have actually panned out, we have seen that the government is struggling with managing the higher crude prices and the under recovery that is actually emanating from there. And we have seen that our estimated under recovery is roughly about 1.7 lakh crores to 1.8 lakh crores for the 3 months ending April, and at unchanged petrol and diesel prices, I think that is unsustainable. So the government has actually started increasing prices by 3 rupees. They have just started. We think that that's very inadequate. And by rough calculation, it's just about 7 to 8% of the under recovery. As a result of which, we think that this will actually pan out over the coming weeks or coming fortnight. So there will be more hikes that one can expect. And remember, we are just talking about the under recovery till April, and the crude can actually be at $100 plus for the coming months as well. So I think this is quite a daunting situation. As a result of which, we think that there will be pass-through of higher energy prices on inflation. We have seen that WPI inflation has scaled up to about 8.4%. There is a 4% month-on-month increase that has happened in April. So I think our sensitivity analysis shows that there will be a pass-through on retail inflation as well. And if this, because the impending price hikes are still to happen, we think that WPI inflation can go beyond 10%. And if this continues, it can go beyond 15% as well. And if you look at the sensitivity with respect to CPI, we have been talking about 6 to 7% CPI inflation, much higher than what RBI has been talking about. And I think we saw some news items which basically shows that the government of India, the Ministry of Finance is expecting something like 5.5 to 6%. So I think the narrative around inflation is changing, and I think eventually RBI will also need to look at it. The considerable amount of monetary easing that RBI did through significant rate cuts, huge amount of liquidity infusion, and also the forbearances or easing of the guardrails of the banking system, undoing whatever tightening that previous governor did. All these things were there, but I think with the outlook of a high inflation, some of these things will need to be scaled back. So I think that is what we are looking at. So rates might actually increase in the second half.
Yeah, absolutely seems to be the case. But Dhananjay, hold on to that thought. I want to talk a lot more about what the RBI stance is going to be and the sector margins and risks we have currently at hand. But I'll quickly cut across. The Vodafone Idea conference call is currently on. Let's listen in as to what the management has to say.
If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Yeah, good afternoon. Thanks for taking my call. Taking my questions. Couple of them. First, on the ARPU, if I adjust the days, it appears that ARPU has grown over 3.2% sequentially. What is driving this strong growth? Because premiumization still underwhelming. We have added only 0.4 million customers on 4G and 5G. So what is driving such a sharp ARPU increment? Is this better engagement with the customer? Can you help us understand, and how much more is left in these efforts to drive organic ARPU growth for us?
Yeah, thanks, Sanjesh. So I'll answer that in two parts. One, obviously, as you rightly said, and which is also reflected in the data consumption that you saw, which has grown over 30%, which clearly reflects that the customers are now experiencing a very different network across the country. Second, I think the increase that we see in our unlimited data customers and the proposition, which is a differentiated proposition that we launched last year, which is the non-stop hero, which really gives the customer the freedom of using unlimited data 24 hours. That really is pushing, and as I said, that quarter on quarter, we see a significant increase of almost 25% on the non-stop hero. So both of these, investment on network, addition of sites, increase in capacity, increase in population. We've also added roughly around 48 million more population to our kitty, which was not being able to experience our services. So all of that put together, is the reflection in the ARPU, which is a very, very strong ARPU growth, and we intend to keep this growth on.
Well, talking about the ARPU trajectory, that's the Vodafone Idea con call. Stock currently at 1274 thereabouts as we speak, mildly soft, a little bit in trade. But back to Dhananjay Sinha. Dhananjay, you were making a very intriguing point about that the RBI has a very tightrope walk ahead of them and they won't have much option but to increase rates. Having said that, do you sense that it's going to be a more calibrated approach, or come next policy we will see a hike come by?
So I think, the RBI will actually try to look through the initial, surge in or increase in inflation. I think where they will actually get more uncomfortable is when it starts going beyond 5%. So remember, at current levels of 5.25, the real rate at 5% will actually be close to zero. So I think based on what I think, my projection of 6%, 7% kind of range, it is quite possible that in the second half of the year, the real repo rate can actually turn negative, and that will actually force RBI to increase rate. That's number one. Number two is that we do anticipate the rupee actually weakening quite sharply. And we have seen that rupee is actually depreciated by almost like 12-13%. Over the last 1 year or so. I would say that the RBI has been intervening, but we think that the RBI's ability to intervene is also receding in the context where the crude oil remains at $100 and above. It's likely that the current trade deficit could rise to almost like 10%. And it's quite likely that capital flows could actually continue to remain modest. As a result of which we think that BOP itself will be in deficit. So the decline in the foreign currency asset, which is currently hovering around $550 billion, which is kind of fairly stagnant over the last 5-6 years. If you look at the import bill because of the increase in or elevated level of crude, the import coverage ratio comes down to something like 6 odd months. So I think that will actually prevent RBI from very aggressively intervening, and that also would imply that the liquidity tightening would happen if they intervene. So I think all said and done, they might have to allow the currency to depreciate, and that would imply that from a currency standpoint also the rates have to go up. So you have both the inflation and the currency depreciation, both creating impulses for RBI to increase rates. So I think that is a fairly fundamental structure of thinking, line of thinking that we have as of now. It will have, all these things will have a implication for markets, corporate earnings, etc. So we can talk about that, especially for the that will be relevant.
Okay, Dhananjay, there is a line in your note that says the Goldilocks economy is a delusion and the window for soft landing is closing faster than we are expecting it to. Can you help us understand this in light of what the economy is showing us in terms of whether we're heading towards a stagflation, or do you believe we're already in the stagflationary phase?
So the thing is that what the RBI had been actually having this narrative for a long time that India is in a Goldilocks scenario, and it's a virtuous situation where you have high growth and low inflation, etc. I think few months back RBI had been reiterating that. However, we think that with the increase in cost inflation because of the energy elevated energy prices, and that it will elevate, it will actually transmit into a broader level of increase in cost of production or general inflation, as we have discussed. That will have an impact on the overall spending power and also the corporate margins and earnings as well. So if you look at the GDP number, the government had actually scaled back roughly about 80,000 crores of nominal GDP in the re-estimated series. So basically there was an overstatement. So if you look at 7-year average CAGR growth for household consumption, that's been growing at something like 3.5 to 3.8% on a CAGR basis. As a result of that, with a rising inflation, it will actually start eating up into that growth also. So I think as this pass-through happens, there will be a slow growth and higher inflation. And I think that's what we think as a stagflationary situation. So there is a considerable shift from a narrative of a Goldilocks to a stagflationary situation. So this is a paradoxical shift that we are talking about. So I think that is how I look at that's basically what we try to sort of express in our report.
Dhananjay, just stay with us. We're going to take a very quick commercial break, but I'll come right back. Wanted to take your opinion on gold specifically. We'll just take a break and be right back. Back with closing trades right here on ET Now. And the closing trades are holding out quite okay for now, at least. We're clinging by with that 23,585 thereabouts mark as we speak right now. Pharma, IT, they're your big movers in trade today. In fact, IT is really powering up ahead, and in bits and starts, chemicals as well sporadically are the ones which are supporting the index right now. But we're still in conversation with Dhananjay Sinha. Dhananjay, thanks for waiting by. I did want to talk to you about the appeal that Prime Minister made for gold and for a restrained gold consumption for the next 1 year. How do you think that piece is going to play out?
So I think this whole narrative around gold has actually also undergone a significant paradigm shift. I would say till few months back, what was being held as a general view, I think it was also shared from an official standpoint, also is that the rise in gold prices would increase the net worth of Indian households. So Indian households hold maximum amount of gold. And with respect to what World Gold Council had estimated, roughly about 24,000 tons of gold is being held by households. So, it was considered to be a virtuous situation. when the gold prices are rising. But right now, what it is seen as is as a drag. So essentially, a rise in gold import is considered to be a drag for the overall BOP scenario. And why we are actually trying to discourage gold import is essentially to balance the BOP. So I think that's the overall context. However, if you look deeper into the data, what we find is that back in 2020, 2011-12, we were importing roughly about 1,100 tons of gold in physical form for consumption purposes. That has actually come down by almost like 45 to 50% now. If you look at the physical import. So the increase in imports essentially is happening because of the rising global prices, not because people are consuming more. In fact, they have been consuming lesser, especially if you exclude, investments in gold bars and coins. The consumption by way of jewelry is actually even lesser. So essentially, that is the physical side of it. What is being targeted here is the gold price effectively, because if you want to reduce the gold import, it effectively means you need to control the gold prices globally, which is not a possibility given the context that over the last 7-8 years, the maximum amount of gold demand has happened by way of increase in gold holding by central banks as people start to move away from dollar assets. And that's largely happening in major countries such as Japan, China, and many other emerging markets, including India. So India has also increased the holding of gold as foreign reserves. So that is basically pulling up the gold prices. And as that has happened, we have seen across the world there has been a considerable rise in demand for investment purposes also, in the form of gold bars and coins, and significantly happening from China, to some extent in India as well. So essentially, when we are targeting gold consumption for jewelry purposes, it has already fallen because of the rising gold prices and the fact that real income for households hasn't really kept pace with the rising cost of living. So that decrease is happening any which way. So I would say that if you are trying to discourage gold imports, I don't think that's going to have a significant impact, because the delta in terms of reduction in physical gold is going to be fairly modest. But the price of gold can continue to surge higher because of the geopolitical development that's happening across the world, the fragmentation that is happening, and the de-dollarization that is happening. So I think it is kind of a sort of a not very well thought out strategy. I would say we are doing the same thing as what Mr. Chidambaram did in 2013 when India was considered to be a fragile five country, and he also increased tariffs, tried to impose restriction on gold imports. And since then, the gold imports have actually fallen, as I said, by 45-50%, and the rupee is actually depreciated by almost like 70 to 80%. So I would say historical data does not really support a view that if you want to discouraging gold imports for, let's say, jewelry or private consumption can actually lead to any improvement in outlook for rupee in particular.
Okay, point taken. That's a very interesting point as well. Dhananjay, thank you so much for your time and good to be speaking with you today.
Thank you.
Okay, viewers, just shifting focus back to the markets, and it's a 350-point recovery from the day's lowest point. We've now crossed the 23,650 level, so looking good for the Nifty. We'll have that updated chart for you soon. And it's sensex that's also up by 0.2%. We've seen some recovery in the mid-cap basket, but the small-cap basket continues to stay pressured with a cut of about 1.5%. One stock that's doing really well and has hit its all-time high is BSE. It's up 3%. Kunal, this is a stock that is up more than 50% in the last 6 months itself. Give us your take on the charts. Does this up move sustain here on?
Yeah, fourth consecutive year for BSE, where the stock has gained tremendously well, 56% up this year. The last, I think, 3-4 weeks have been particularly quite positive, because in this last 3-4 weeks, the markets have gone to a choppy kind of a consolidation. But this stock has managed to eke out further gains for itself. I think the last 3 or 4 weeks itself, the stock has gained some 500, 600 points from 3,500 mark towards 4,100 plus levels where it's trading right now. So it's a stock which is into fine fettle, looks attractive at the current juncture. I think traders who are holding on to the long positions, I don't see any reason why they should look to exit.
Okay, that's BSC, a PE of 68, but Kunal believes that this is going to be one solid mover from here as well. But we caught up with the management of Fusion Finance as well, Sanjay Garyali, the MD and CEO, after the company posted a very steady set of Q4 numbers. What's the business growth guidance shaping up like? Let's hear out what he had to tell us.
The recovery in growth is here to stay. And we would want to reconfirm that the 10,000 crore guidance that we have given for next year is absolutely on target. In fact, April and May, first 2 months of this year, already about 50 days have gone by. The performance is bang on plan, whatever we had planned for this year from an AOP perspective. Along with that, the portfolio quality continues to be pristine because it is very important that while we are growing, the portfolio remains pristine. That continues to be from a collection efficiency perspective at about 99.8, 99.9. So we are fairly confident on growth going forward in a very calibrated manner, and the portfolio quality will continue to be pristine.
Okay, that's the word coming in from the management of Fusion Finance. On the back of its earnings, the stock is lower by about 8.5%. Kunal, in the last 6 months, the stock is up 9%. Similar moves to the last 1 month. So it's been steady. But this 8% fall in today's trade, does that prove to be a good buying opportunity, or would you avoid the stock for now?
I'll avoid the stock. I don't track the stock, frankly, stay over the short to medium term charts. It's just that over the last 1.5 odd year, I was just looking at the the longer term charts. The stock has been a lot more sideways. It's been trading, and prior to that, the stock had fallen from 600, 650 levels. So after a sell-off of almost 50% for the stock, more than 50% for the stock from those higher levels of 600 plus mark, it just looks like that the stock is going through a patch of a multi-quarter consolidation. So I think in the midst of this consolidation, very difficult to try and go for a buy into this thing.
Okay, let's address what's happening in the market right now after this solid rebound. Sajeev is here with FNO 360.
Thanks, Aisha, for that. The market's absolutely flat at this point in time, coming off day's low, nearly 300 point jump from day's low for the Nifty there. The Nifty, as we speak, is seeing some kind of short covering which is there, and that's reflected in the open interest fall, which is the 2.6% fall in Nifty open interest. The Nifty is trading at a discount of 11 points, absolutely flat as we speak. Nifty Bank again is down in today's trade, a third of a percent down. Open interest up nearly 0.4%, but the premium item 126 for the Nifty Bank. So there's some shorts which are getting built on Nifty Bank as you speak there. But Nifty Bank constituents, you have two sides. One is the private sector banks where we are seeing some long build-up happening, and the other is the public sector bank where we are seeing some short build-up happening or some unwinding of positions which are underway, long unwinding which is underway there. Look at what's happening in the call and puts writers there. You're seeing a good amount of action happening in 23,500 and 600 and 700 level, with unwinding of puts happening at 23,700 and call writers having a big upper hand there. And that's what is reflected in the distribution chart, where the call writers have an upper hand over and the Nifty hovering just below the 23,700 mark at this point in time. Of course, 23,500 acts as a good support and 24,000 as a good resistance for the Nifty going forward, going to next week's expiry or the monthly expiry for the index there. In the Nifty, in the futures gainers, you have a persistent where we are seeing long build-up. Coforge is seeing a short covering, and Oracle Finance is seeing a long build-up. So IT stock are the sector of the day today, especially the second rank IT pack where we are seeing some activity. Stocks up nearly 4 to 5% in today's trade. Futures losers includes EMS stocks. Amber is down on the back of short build-up. PG Electro is down nearly 5%, and TVS Motor is down 5.39% after the news of company picking up stake in Jana Small Finance Bank, which came in today. Among the open interest gainers, you have Amber, nearly 30% jump in open interest, short build-up happening. Godfrey Phillips is seeing a short build-up of 20% jump in open interest, and Cochin Shipyard is seeing a 9% jump in open interest. All things some short build-up in today's trade. Open interest losers include stocks like Bharat Forge, where there's a long unwind. L&T Finance is seeing a long unwind, and Nippon Life is seeing a long unwind. The open interest down nearly 2.5% in today's trade there. But the most active is Tata Steel. If you look at 210 May call, 57 lakh contracts getting added there. The premium down nearly 5.78 to 3.16. The stock hovering around the 210 mark there, and the stock down nearly 7 rupees in today's trade. Among the most active one has been Amber, 7,000 May put for Amber. The premium up nearly 122.90 at 146.65. So a large jump in premium coming in, and the open interest up nearly 71,000 contracts. The stock down nearly 1370 rupees at 7,137 as we speak in the futures market. So it's overall, the flat closing. It seems to be a flat closing, but there is a lot of shorts which are getting covered in today's trade, with the Nifty hovering, trying to end at the same level as Friday.
Ji, thanks so much for taking us through that. So that's everything that's transpiring in the F&O universe as we speak. Let's take that conversation ahead. We've got Mr. Vinay Rajani of HDFC Securities, who's joined us on the show. And Vinay, thanks for your time today. First of all, good afternoon. Talk to us about the kind of recovery that we've seen in the Nifty today, and especially the kind of move that the entire IT pack is seeing, particularly the mid-cap IT basket. What's looking good from here on the charts?
Recovery, good afternoon. So nice recovery from our level, more than 350 points rise, and Nifty managed to protect the previous swing low of 23,262. That's a good sign. And the recovery is there in IT. Some of the pharma stocks are doing well. So yes, in IT we like Oracle Finance and the stock like, of course, these two stocks first and can be traded along with the proprietary sources. So yes, data-wise also, activity suggests that there is a downside is limited, and for the time being, we can expect this 23,262 be protected, and ultimately we can attempt some extension of the recovery from here as well. So we are expecting that in the coming time, we may see a level of 23,800 to 23,900 in the Nifty. So bias is positive, especially after the recovery that we have seen in the market. We may see extension of the recovery, and as I said, 23,800 to 900 is the probable target. And as far as trading ideas is concerned, from the IT space, we like hands trading around 9,400. Stop loss can be kept at 9,200. On the upside, we can expect a target of 9,750. The second stock I like from the has been resilient and continues the outperforming the broader markets. So Sun Pharma from the large cap pharma space, we like around 180, 18991 can go long. 1865 should be trading stop loss. On the upside, we can expect a target of 1960.
Okay, so that's on that's some of the stocks that you're liking, and your reading of the overall market too. Let's talk about PSU banks. Vinay, the pack is under pressure by about 2%, with some of the biggest cuts seen on Bank of India, SBI and Canara Bank. Would you buy the dip in any of these names?
No, I would not go against the trend. They are looking weak and rate sectors now, especially PSU banks have started underperforming the private sector banks. So looking weak on the chart, not to anticipate any bottom, and we should not go against the trend. So I would not touch and go long PSU counter right now.
Right. Okay, we've got Varun Saboo as well joining in on the show right now. Varun, hi, great to have you on the show. Varun, what is it that you're making of the market right now? And in specific, this IT rebound that one is seeing, does it seem more tactical in nature, more a currency trade than anything meaningful right now?
Yeah, so thanks, Edina team, for inviting us on the show. These are extremely different times, right? You're seeing volatility across, be it index, be it any of these sectors also that you're seeing. IT particularly has corrected so much that there's a lot of value lying. I think today, most of the large caps are trading between 13, 14, 15 times earnings. these are unheard of valuations. So what the market is saying is that they're not sure about how earnings is going to turn out to be. So you're right that currency has been weakening. So probably one of the only space where there was some ray of hope that, okay, currency would give some tailwind. But eventually they're going through a major disruption. As such, as a house view, we are very, very positive on IT. But I would still suggest, let's see how things move, how this AI disruption goes on, and then probably someone takes a structural bet here. But yes, where the valuations are, this could be a tactical bet here.
That's on IT. Varun, hi, good afternoon. I'll come to you for your view on some of the pharma names. Before that, hear out from the management of Gland Pharma. That stock is in the pink of health today. And let's take it across, in fact, to Meryl, who's joining us with an earnings breakthrough and what's keeping the stock so abuzz in today's trade. Meryl.
Yes, Gland Pharma has seen an exceptionally strong quarter this time around. They've seen revenues up 22%, EBITDA up 47.6%. Margins have also seen an expansion, while the company's profitability has grown the largest at 96% on a year-on-year basis. Now, this has beat the street's expectations for the stock and in its fourth quarter earnings. And in terms of operational performance, the company has also seen its other income rise up to 153% on a year-on-year basis. Now, this strong performance mainly came from the company's CDMO business, contributing 46% of revenues in the fourth quarter, which grew 36% on a year-on-year basis. Geography-wise as well, the company's recorded more than strong double-digit growth in most of its geographies. India businesses especially up almost 30% on a year-on-year basis. Going forward, the company's also given very strong guidances for the coming few years. For FY27, the consolidated growth guidance for the company stands at around 12 to 13%, which is on a constant currency basis, immediately a positive. And another key aspect is that this excludes any further impact from the company's GLP-1 performance. So any strong growth on that front will only be a direct contributor to even stronger growth for the company. And this positive management guidance is what is seen to be driving the stock up today in today's trade.
Yeah, that it is. Not just Gland, but look at the rest of the pharma pack as well. Varun, curious to know, where is it that you find opportunity within pharma?
See, honestly, we don't have any active coverage right now on the pharma sector. But pharma is benefiting again from the currency tailwind, being a defensive in these times. You're going to see only generic pharma doing well from here. So I think it's a broad-based thing where people are taking a bet on pharma more than any other sector. Even IT is going up, but IT generally has been very patchy despite currency weakening. I think pharma from that per se is relatively insulated from any other shock which is there. So that's where you're seeing the strength coming in from.
Okay, so that's on pharma. And we've spoken about a bunch of sectors. We've taken a look at PSU banks, spoken about IT and pharma. Kunal, let's come to you. Talk to us about auto. At one point, this was the top losing sector of the day. We've seen mild recovery from the day's low for the auto index. But currently, all the stocks in that index are in the red. And the cuts are seeing, the biggest cuts are rather being seen in Uno Minda. And that's followed by TVS Motors and Hero MotoCorp. Anywhere you'd make a fresh entry?
So I think the only stock which is looking attractive from the auto pack is Bajaj Auto, specifically with the stock recently breaking past about the 10,000 mark, and that stock confirming sort of a leadership up move with respect to many of its other peers, both on the two-wheelers as well as broadly on the four-wheeler segment at large. The auto anch names also, I think, are the ones which are still going to a mild corrective wave. I think Uno Minda, look at Sona, BLW. I think many of these stocks are still going through their swing breakdown modes. Even the traditional or the four-wheeler names, the likes of M&M, Maruti, they're not seeing any major respite or any kind of a big recovery for themselves on the short to medium-term charts. You look at the other rider spaces, the ones which had done fabulously well in 2023-24, Ashok Leyland, TVS Motors. Even on the short-term charts for these stocks, they are threatening to come back closer to their swing low support. So you look at the structure broadly across the board for the auto stocks, two-wheelers, four-wheelers, the auto anch, etc. The charts are a lot more weaker. And that's why I think the sector continues to underperform. The only exception over here so far, I think, has been Bajaj Auto.
Okay, and we've also got earnings from Apollo Micro that are flashing on the bottom of your screen. That stock has seen an uptick of about 8%. That's been a very sharp spike up on that stock. The revenue has almost doubled. It's up about 80%, so slightly lesser than that at 293 crores. The EBITDA is up 90%. Margins have also seen a little bit of an expansion, but the profit has more than doubled this time. It's coming at 37.5 crores compared to 14 crores. So if you see the intraday chart for Apollo Micro, you've seen that sharp spike coming in on the stock. It's 7% higher and looking very good for that stock. On the flip side, a stock that's under pressure is KC International. That one has slipped on the back of weak Q4 earnings. The management sees labour shortages, supply chain disruption continuing in Q1 and Q2 of FY27. Rabinder is joining us with more details.
Well, as KC International is in focus after reporting its weak Q4 FY26 earnings and slight negative commentary in the con call. If we talk about the numbers, the company reported overall weak set of numbers in Q4 FY26, and management commentary is were also slight negative in the con call, where management said that due to fuel issue and election in some state, there was a labor issue, and which has impacted the company's operation in Q4 FY26, and which will continue to affect in the Q1 and Q2 of FY27, and management noted a challenging operating environment in FY26, which is marked by geopolitical tension in Middle East, labor shortages, and subdued order inflow in the Indian market. And geopolitical disruption in the Middle East led to supply chain and logistic challenges, which has impacted the Q4 FY26 and expected to continue in the first Q1 of FY27. And management say that the company is set to improve by the Q2 of FY27, and outlook for the T&D sector remains very strong, which is driven by the strong electricity demand. And in FY26, KEC has received major order in semiconductor, hospitals, thermal power, and thermal power segment. And despite geopolitical uncertainty, KEC continue to remain well poised for the strong growth, and management has not provided any margin guidance for FY27 because of the geopolitical uncertainty. And but they have given a revenue guidance. They said the revenue is expected to grow at 12 to 15% for FY27, and order intake around 30,000 crores. So back of the weak earnings and slight negative commentary, KEC International is under pressure.
Right, okay, that's KEC, and that explains why the stock is falling the way it is. Vinay, wanted to get your sense in on some of these EMS plays, Amber, PGEL. The entire pack is looking fairly under pressure. We were talking about Dixon, etc. as well.
Yeah, after hitting a 50-week high, the stock after results they are actually changing their trend. So whipsaws are there, and the entire trend is getting changed right now. So better to stay away, let it cool it down first, let it consolidate a bit. But primary trend is still positive in the stock like Sirma or Amber. The weekly, monthly charts, but daily charts definitely I can see some weakness, and this week is from here. So better wait for some consolidation or some pullback, and then we will review it. But as of now, better to ignore for the traders.
Okay, so that's it coming in on Amber. Vinay, on that note, we'll let you go. Thank you so much for your time today. But while we're talking about the stock, hear out what the management had to say in terms of their growth guidance.
On the top line side, you would have seen that its organic expansion is looking little subdued. But on the margin side, if you have seen, this quarter has delivered 10.8% margin. So we are pretty much on line to deliver what we've spoken. In future also, this kind of shifts can happen. We don't control what customer wishes from us. We serve them in whatever shape and form they want us to serve. In case of sub-assemblies or components or just job work basis, or this keep on changing with the management changes. But as given the guidance, we are very hopeful looking into the order book right now for the whole electronic division. We are positive, very confident to deliver about 40% of growth this year.
Okay, so that's the word coming in from the management of Amber Enterprises. We've got less than about 5 minutes left for trade. Varun, quick thoughts on where do you think the markets are going to head in this, in the near term rather? Your take on some sectors that could outperform and some that could underperform.
See, I think markets are in a very tricky situation. It is a very binary event on how this entire Iran-US thing shapes up, how crude is going to shape up. The one thing which is bothering our economy is crude and then currency, etc., which is in relation to how crude is playing out, how current account is playing out. Globally, interest rates are shooting up. That's causing concern around there. So all these things are there, but they can be very binary. If tomorrow the war noise, etc., has to settle down, you'll see sharp reversals also happening. My bigger point is that we should look at bottom-up strong ideas. I think hospitals is a great place to be in. This is one space where most of the capacity expansion has happened in the last 1.5, 2 years. You're going to see sharp EBITDA improvement across going forward. These are extremely high on operating leverage businesses. So you're going to see a lot of benefit now flowing once the expansion is through. Hospitals is looking very attractive to me. Something like an LIC housing as an idea is a very, very strong idea. This is one of the best plays because this is one idea where they have a fixed asset book, but on the other hand, the rates are floating in terms of assets, while on the liability side, it's a 3-year borrowing cost, so which is fixed. So that is the kind of tailwind you're going to get in LIC housing. Best play on an interest rate rising scenario, and also available at 0.6 times book, looking very attractive to me. So there are pockets of strengths which one can look at where earnings are also comfortable, valuations are looking good, and best is to be bottom up and look at stocks which are safe right now in these times.
Okay, Varun, on that note, thanks so much for your time. Good to be speaking with you. We've got a couple of minutes left. Let's quickly take in a call from Kunal as well before we wrap up. Kunal, the level that we've held on to, 23,650 thereabouts, we're right there. Can we see this level tomorrow as well?
Yeah, I think we should see, hopefully, I think if the crude oil prices don't spike up to say 112, 13 plus mark, then I think we should be opening on a slightly positive note, because today's move is spread across, larger cap names and dominant large cap names, specifically on the banking side, and then on the IT sector overall, along with the pharma names. So I think when you see large cap stocks showing signs of strength or coming back into a recovery phase, we generally expect that the market sees a follow through. Unless the data points across the globe, I think they start to be on the more higher side. But I think adding to the fact, tomorrow also being the weekly expiry for the Nifty, we are seeing a very good build-up at 23,600 to 700 strikes for the index. So which means tomorrow, again, a higher probability that the markets should hold on to this 23,600 plus mark.
Okay.
Right. Okay, Kunal, we'll let you go on that note. Varun, good to be chatting with you as well. Let's begin winding up for the day. And it's been a remarkable recovery, given that we were down about over 200 points when we started off trade. From that to just about inching into the shade of green is quite commendable. So closing in 16 points higher for the Nifty futures at 23,660 in trade. It's really been IT all the way. Liquid Persistent, Coforge, Oracle Finance, TechM, Emphasis, Infosys, Wipro, HCL Technologies, all and every constituent of the Nifty IT index has participated in the move today and definitely has cushioned the index. More than that, it was Bharti Airtel as well, and now the second most valuable company in the country. It's overtaken HDFC Bank. Bharti managed to leap up about 1.7% in trade. Bajaj Finance, Kotak Bank, Sun Pharma, these were other contributors to today's move, along with, of course, ICICI Bank, L&T, HDFC Bank. They too recovered some lost ground. Didn't resurrect though for SBI. It languished. M&M, Maruti, these were all stocks in the red. Bajaj Auto as well. Power Grid too was lower. And then Tata Steel, which languished by over 3% in the futures towards closing. Having said that, the breadth of the market was also unable to recover. You had an Uno Minda, which was down 5% in trade. Godfrey Phillips, which fell about 5%. And then the entire EMS play, Keynes, PGEL, Amber, they were all out. In fact, Amber fell over 16%. PG Electroplast was down 6%, and Keynes as well, which lost another 5.7% in trade.
Okay, with that, we completely timed out on this edition of Closing Trades, and we've managed to hold on to that 23,600 mark at least for now. Nifty expiry tomorrow, so we'll see what happens. But with that, we completely timed out. Thanks so much for tuning in.